So today we're going to discuss private equity, and I'd like to introduce Maureen Downey, who's a senior investment professional with a broad experience as an alternative asset allocator and whom I've known for several years, as well as a direct and secondary investor across all private asset classes in funds and directly into companies. She also has been a portfolio manager for both traditional private funds as well as an Evergreen 40 Act fund. And Dominic Foster, founder of, and how do you pronounce Avkha?
Avkha.
Yeah. Thank you, Avkha. I'll probably mess that up a few times, so bear with me. Who's joining us for the first time to our community. So welcome. In welcoming you both, want to ask Dominic to elaborate more on his background because Maureen, you have spoken here before. So, and as we engage in this discussion, I'd like to encourage the audience to ask questions that are relevant to their portfolios or allocation strategies as the alternative market has evolved into a very broad asset class. So with that said, please introduce yourself and tell us a little bit about your background and what led you to your current focus.
Yeah, so my name is Dominic Foster, been in the Bay Area about 13 years now. I run Avkha Equity Holdings. We are an emerging fund. Right now, we act as an independent sponsor. We started about 2 years ago. A little bit about my background. I raised over 100 million debt and equity. I've partnered with family offices, other private equity firms, and private credit over the last 7 years before I started Avkha Equity Holdings. We also have some family funds that are directly out of Chicago, where we've done private money loans into multifamily, into adults with disability homes, and some other things before I started Avkha. So I'm very familiar with the family office space, understanding that mindset. What led me to start Avkha was I also consulted for equity. Ever since I was younger, I even think I told Karen, I've always wanted to acquire businesses. Ever since I watched Pretty Woman, wanted to buy businesses and then just leave the Julia Roberts character out of it.
All aspects of it?
All aspects. I'm a family man. That being said, when we started Avkha, we immediately acquired our first business, which is Madison Parker Finance out of Long Island, New York. It's more of a fintech space. They have facilitated over about $500 million in private loans. These are anything from MCA advances to private credit. We will speak with anybody that does anything from about $2 million in revenue all the way up to $100 million in revenue. Our focus mainly is on alternative finance just because I have that background. Also wholesale, distribution, transportation, e-commerce businesses, cleaning companies, specifically like commercial cleaning companies. I'll look at oil tank cleaning. And yeah, that's pretty much where we're at. We tend to focus on companies, and we'll be raising our fund. We just signed LOI on another transportation company about 48 hours ago. So I am a busy man for the next quarter. But we tend to focus on businesses doing anywhere from 2 million in EBITDA up to 50 million in EBITDA and maxing out at about 200 million in revenue. We want them to have 7+ years in business. Really, our sweet spot is about 10 years in business, where they really have a management team that is in place. We look to add technology or build that technology out ourselves. For an example, in Madison Parker Finance, we are building out AI bots, but we also built out the entire marketing department for that so that we wouldn't have to rely on vendors. We were spending about $200,000 a month on marketing materials. So brought that back in-house and reduced those expenses.
Well, that's very interesting. I'm glad you shared with the audience your Pretty Woman story. Oh, I'm sorry, Marty. I end up, me just talking directly versus knowing I have an audience to deal with. Sorry. Maureen, based on the focus then for family offices that Dominic just shared, would you have a comment or two to add in terms of their focus?
Yeah, in terms of like the type of investments that he's doing.
Correct.
So I guess the question I would have for you, Dominic, is do you have a fund that's raised now, or are you basically trying to do investments and then going out to family offices or other types of investors and syndicating those deals
Yeah.
and doing it simultaneously to when you're raising your fund?
Exactly. So we do act as an independent sponsor. So what that means is we'll be raising a fund at the second half of the year. We just wanted to complete 2 acquisitions before that. We have some people that are going to commit capital to that already. We'll be looking to do about 120 million in that raise. We wanted to do deals first. Specifically me, I wanted to do deals first. Coming from the lending side, you can't really know how a person operates until they close something. Everything else is just smoke and mirrors. So I like to get something under LOI. So we do raise as we do it, but we pretty much have those capital partners in mind as well as the management team when we're raising.
I guess from my perspective, and this obviously you're in the process of doing these deals. One of the things that I would be thinking about it if I were a family office would be, one, there is the obvious question of you put it under LOI and you have to close it and you have to execute it. But then the other thing is to be able to see how you would grow value in the company and then ultimately, of course, be able to exit it. But I guess when you're doing these would you characterize it as a search fund or a fundless sponsor or just
independent sponsor is
independent sponsor?
is like a fundless sponsor.
Okay.
It's pretty much interchangeable.
Yeah,
Yeah,
well, that's what I thought too.
Yeah.
But do you yourself put up capital
Yes.
alongside?
Yeah, so we'll put up capital and then half of my fee, because we do charge a fee, also goes into the capital side as well.
Yeah. So that's always been an important component to me when I've looked at doing transactions with independent sponsors, is to understand the alignment. And usually it's not even a question of like how much money you put in, but more a question of what percentage of your net worth are you putting into that? Because that to me means, we're better aligned. You're going to actually make sure that this transaction comes to fruition. I guess the question for you is, how have you found it in terms of going out to the investor community? Have they been asking for you to do transactions first to essentially develop a track record before actually putting capital into the fund? Or have they been, okay, I'll put money into the transaction and maybe a portion of that into your fund? I'm just kind of curious about the interaction that you've had.
So to be honest with you, I was actually approached by my investors to do a fund. And some other family members as well, from some other family office communities. They liked that. When I was just doing transaction, and the beautiful part about me is when you invest with a fund, you don't know where those transactions are going to go. Either you're on the LP side or the GP side, you may get an idea, and maybe you can speak to that as well as how you speak with your investors. With me, you're looking at this deal. This is the deal. This is the management team set up for this deal. This is when we're going to exit. And, we're aligning those values as well to it. I wanted to do it this way. Some of the people that we have on my team did not, but I felt when we went out to raise, it would actually show how we operated. Obviously, this is business. You're going to go through ups and downs. And a big thing is, especially with an independent sponsor, the only real kickback that I get is he going to be there through the ups and the downs? And we faced ups and downs, and we just don't quit. Specifically me, I am a very hard-headed person. So I can't quit.
Fantastic. We need to move on from that topic. We love independent sponsors, so keep on going.
But with that said, right? So key man risk, emerging managers. I've been involved in emerging manager space for decades. So how then would you speak to that regarding hard to raise capital? So even though you have, as an emerging manager, even though you've done, and I'm very appreciative and congratulations on the 2 transactions. So maybe you could speak at some point about the return.
Sure. Well, I think, obviously one of the questions when you're looking at, I think, emerging managers or any, frankly, manager where you have a key man risk, especially as an LP, is what happens if somebody gets hit by a bus. And, one of the big negotiations that you have to sit with any manager is to say, okay, you may have one dominant GP, you may have one dominant GP and then several, I would say, partners in the fund, but then how do you define the key man? And then if you actually get a key man triggered, what does that mean then? How do you actually replace a GP or how do you restaff a GP? You know, I've in my career, I've worked at a large fund of funds, and then I've obviously been directly in funds or run funds. I've had to restructure a lot of funds, either as a primary investor or as a secondary investor. And I can say nobody really wants to do that. It is a black hole of your time. And so I think thinking through, especially as you're looking at an emerging manager and thinking about how do I make sure that we have the alignment? How do I make sure that I have provisions to maybe remove it? That's the last thing you want to do. So that's why the alignment is so key. But the alignment is key not only between you and the GP, but also within the GP too, because you want to make sure that who's ever part of that GP, that they're aligned and they want to stay together for the next 10 years. So I think from a key man perspective, I think it's, important to look at the alignment. Usually that's the last thing that you're able to ask when you're doing due diligence, the economics of who owns the GP and then how's the carry split. But then I think second, between yourself and the GP is to, define a reasonable key man clause and then just frankly hope that you're never going to have to actually exercise it.
This is a great topic. I'd like to move on from it and really talk about what's the outlook for private equity and also talk about liquidity premiums and things like that. So if we can move on to that, that'd be
That
great.
was one of our questions, Marty.
Great, let's go.
He wants to speed us up, so.
All right, so I guess talking about like liquidity premiums on private equity right now, in terms of you thinking about liquidity premiums, Marty, was your question more on like the secondary side or more on in terms of like going into like directly into funds, just to give, or just on direct
we really
assets?
didn't bring it up in venture capital, but it's the same rule, it's the same question, which is that, there's a liquidity premium when you're investing in any sort of private equity, whether it's venture capital or private equity,
Mhm.
et cetera, because that capital is not available to you, right? So what is the premium that it has to deliver to you for you to be investing in it,
Yeah.
right? Because the reality is you can invest in a fund or a deal, and it depends on what kind of control you have over the deal or fund for your ability to get liquidity out of it. I mean, maybe there's secondaries, but not every private equity fund has
No.
desirable secondary markets, right?
No. So I think it's a great question. And I think to some extent, it depends on whether you're like an institutional investor or to some extent a family office. And I think the reason for that is you sometimes have more options, at least to do portfolio rebalancing when you're an institutional investor, just because you have bigger stakes. Usually you have more resources to be able to kind of do the tools for portfolio rebalancing. Also, I would say most institutions are just in funds, whereas I think family offices, from my perspective, I've seen a lot of direct investments into companies, right? And so those tend to be harder to get liquidity on. And many times the stakes are smaller. So again, it doesn't attract as big a buyer base. And I apologize. Of course that happens. Excuse me for 1 second. Sure.
Maybe Dominic can talk about how he addresses that and what's the duration of his investments.
Yeah, our duration that we look to in our investments is max out at 5 years. So all of these investments we would like to max. I would like to say, because we are independent sponsor, if somebody offers me to buy my company, which we recently just got an offer on our first acquisition, I'll always entertain it. My goal is one, to get, with the larger deals, it's a little bit different, but it's to get everybody's money back out as soon as possible. And to have those distributions coming out as quick as possible. And, if I can exit them out, it depends on what that investor, much like what you said earlier about, when we're going into that investment, we're negotiating all of that. And we want to partner with our investors, especially with some of the people that we're bringing on, because we want to know their experience on it and how their outlook and their strategy would be. Obviously, we're the experts on it, but a lot of investors that we partner with, specifically family offices as well, have had history in investing in those companies and know when the market is good to exit and when not. And we're trying to figure that out all at the beginning. But max is 5 years. We don't look to stay longer than that.
Yeah, just go back to your question specifically, Marty. I'd say 300 to 500 basis points, depending on what you're looking at, above public markets is kind of what the target has been for alternatives. But I'd also say to Marty that it depends on how much time you think you're going to be locked up, because before you used to be locked up for a much shorter period of time. And now I think it's anywhere between 13 to 16 years that you can be stuck in a fund. And nowadays in the last, I would say it started back in like the 2008, 2009, the whole continuation funds. But now they're a huge part of the secondary market. And they're not just like a fund of like, 5 or 6 assets, but maybe one asset. And so sometimes you don't necessarily have an option to get out of it if you're approached by the GP and a secondary player at a great price. So I think that's something that you really need to think about when you get into a fund. Is it may not be 10, 12 years, but it may be 16 or 18 years. And what happens is that you need to really think about how they can charge the fees, because your IRR will keep going down. Your MOIC probably will stay the same, but your IRR will degrade, which is why when you look at primary funds versus secondary funds, usually primary funds have a better MOIC and usually sometimes a better IRR. But if you stay in a secondary fund for a long time, you'll see that the IRR degrades much more quickly, because you're basically peaking at about like 5 or 6 years for the NAV or the AUM value in a secondary fund.
But also the question with that is, when you're with a primary fund, is whether it's opaque or not, the opaqueness of it, right? So if you're investing in a secondary fund, typically you get more of a choice, or if you're investing in secondaries, you get more of a choice of what you're going to be looking at.
Well, I would say no, actually probably the reverse, because with a primary fund, you come into it, you got a blank check, and the GP has the ability to kind of construct basically what's in the fund. The difference is when you are a secondary investor, like if I'm the GP of a secondary fund, I get to construct it, and actually it's a little bit better of a risk perspective, because I can already see what's in the fund and I can have a good chance of valuing it. Now, there's going to be certainly a percentage of that needs to be called, and then I have to assume when that money is going to be called down. I have to assume what the multiple is going to be made on that money that needs to be called down, and when I'm going to get that money back. So these are assumptions that I have to make. But as a LP coming into a secondary fund, it's actually a lot more opaque.
The commentary isn't as an LP. It's about being an investor in secondaries. So not about a fund. It's about investing in secondaries. That's what my comment is.
Oh, okay. All right. Well, apologies. Yeah, I do think you have more of an ability to kind of see what the assets are, and so that can lower the risk. But I would also say that if you're investing in other currencies, though, there's a lot more risk to that, because at least from my perspective, that's where I've actually had negative consequences, because you don't have as much time to recover from currency shocks.
I think the question of currency shocks and of liquidity premiums are really relevant, in particular when there's down cycles and Wall Street says, if you're in the public markets, it's time to rotate to something in another country, far away. A lot of our guys got into China 20 years ago, and then they found out it was almost impossible to export capital if there was an exit, right? Same thing with a lot of people who invested in India. Although it's gotten better, I mean, India has an organization that's totally oriented towards repatriating capital, right?
Yeah, I think with the India part though too, is that a lot of those funds also did public and private investments, and they went into a lot of pipes in the public market, which had a lot of illiquidity there too. But your point is valid in that one of the issues, I think, when you get big liquidity discounts, especially in the venture market in the last couple of years, is that the valuations that are perceived in the private market are not corresponding to where GPs are continuing to mark the positions. And so that's where you get really big discounts. And then obviously people that are holding those positions in the funds don't want to take those discounts.
Well, that leads into how do we, what's the approach of family offices analyzing their legacy private portfolios, right? So,
So can I just make a comment on legacy private equity portfolios for family office? So there's a heavy survivorship bias with family offices, because a lot of times there are guys who are buyers of private stakes, right? I mean, there's a guy in Pittsburgh, he became super wealthy and he kind of bought into all of his colleagues and college alumni friends' businesses. And by the end, he owned 125 companies, of which only 30 were desirable, right? I mean, so the son-in-law came in, got sold off 70 companies. I mean, the same thing is the story with Paul Allen. Paul Allen had stakes in so many things. And one guy came in who's been a member of our group for years, and he got rid of 70% of the portfolio, right? I mean, so sometimes these portfolios get overburdened with the privates. And I guess one of the questions I have for you, Maureen, and Dominic is, what's the right allocation of staffing when you start investing in directs and in private equity?
Well, that's a good question because you've seen it with the Canadian pension plans going back about 15 or so years ago. They really made a big push into going directs, and they were very vocal. Ontario teachers, and a number of them saying, we're going to develop our own big direct investing capabilities. We don't want to pay the fees to the fund managers. I think it went okay, but it didn't go great. And so they've gone back to, I would say, more of a compromised relationship with some of the larger GPs where they make a bigger investment into a fund, but they have more defined co-investment rights, and the co-investment rights come with lower fees and lower carry. So you're basically reducing your fee load that way, because there is an expertise that comes with some of these larger managers and mid-market managers who have maybe more of a segment or a sector specialist. I think with family offices, one of the things that I've noticed is that they have a different network of deal flow that you probably won't get at the institutional pension level, because many times at the institutional pension level, they don't actually have staff to be able to do the co-investments. So one of the things that you've seen over the last 10, 15 years is that many of the fund of funds who are not able to charge the fees they were, say, 10, 20, 15 years ago on the primary investments have developed more secondary capabilities as well as co-investment capabilities. And those funds are sold to some of the more institutional managers. And that's kind of where they've been able to generate fees. But I would say, co-investments done correctly, if you have a good deal flow, are certainly a better way to invest money from like an IRR and MOIC perspective.
And what's attractive to in putting a fund together is to allow the co-investments free of fees. I worked on 2 funds that did that, close to $2 billion, and it was very attractive. Everybody was fighting each other for the co-investment opportunities. Have you thought about that? And
I just left a family office event, and in terms of staff, if I can answer your question, Marty, when I'm speaking with family offices, for an example, I pitched a guy yesterday. He's out of Florida. His family built suburbs. They got about $100 billion of assets under management, and it's all family owned. And so when I'm speaking with him and he's speaking with me, I'm speaking with him and his CIO, and a couple other family members, just trying to understand where they're at, and then their staff. And then they're speaking with my CFO, because we are small, right? We outsource a lot of our legal, but we keep everything else as far as our financial, our accounting, all of that stuff, some of our legal in-house. But when I'm speaking to a family office, the reason why they want to talk to me is because they don't want what you said earlier. They don't want their money locked up. Mm-hmm. And they're able to compete with other private credit funds, which is another outlook that private equity has that they may not have. They're able to and then they're able to get yields that they can invest with, right? So they can come in on a debt, for an example, in a deal that I'm looking at, they can come in and say, hey, we're going to amortize this over 10 years. We're going to charge you about 15% interest only on that debt for the first 3 years. Then maybe you'll have a balloon or something at the 4th year. But we're also going to invest with you as well on the equity side. So they get to look at the deal, they get to understand it. And anybody in the audience that has a family office, they are more operators. So they like to speak with operators and they like to be able to talk and have an impact. At least that's what I've personally found. Everybody has their own idea of how they work with family offices. But as I've gone over the years, they like to be able to talk. They like to be able to touch and feel and really speak with the managers and then also not have their money held up for 15 years or 10 years, because at the end of the day, it is their family's money. And us as fund managers or as sponsors have to know that this isn't, and I work with funds too, these people built their money from their grandfather or their great grandfather. And what's harder than anything from what I've seen other than building your wealth is sustaining it over a longer period of time. And us as sponsors, when we're speaking with the CIOs, they all have that mindset, and you have to be sensitive to that. The CIOs know that, and CIOs who do not know that do not last long within that. And that's pretty much all I have to say when it comes to that staff on that.
You asked a question, Marty, though, too, about the survivorship bias. You end up having this quite a bit, I think, in institutional portfolios. And I think you've seen over the last, say, 10, 15, 20 years, the secondary market has gotten really big. Every time you get a new CIO that comes in, you tend to see a big portfolio sale because, the new person coming in doesn't necessarily want to be responsible for what his predecessor or her predecessor did. That happens quite a bit. And then also too, you're taking that cash that you've raised, and it's cash that you want, and you're redeploying it into something that you have conviction on. It gets a little bit more complicated when you have, let's just say, a portfolio that's like not funds. I've seen this before, and I saw it back in like 2009 in particular, when a lot of hedge funds got in trouble, who'd put a lot of private equity funds and private companies into their global macro fund, and how to sell that. And it wasn't as palatable because the secondary market has diversified so much, though, especially in the last 10 years. There's more intermediaries out there to help sell them. But I've normally found that if you are, from like an efficiency process, if you can package your assets up as a bigger portfolio, that's more palatable if you're trying to sell it to a larger secondary fund. If you wanted to kind of just basically take a look at your assets and liquidate basically what you don't think has the same potential, or you want to just get rid of it. A lot of times when auctions are run, what happens is that an intermediary or anybody who's trying to sell it can sell it to different buyers. And that's something that optimizes the price. The other thing I would probably say is, when I've actually had to go through about 10 billion of AUM across 7 funds, and I had to figure out what I was going to sell and what to keep. And some of them were in fund-to-fund portfolios. Some of them I decided to close the entire fund of funds and just liquidate everything. It can be a very laborious process. I can go into detail and tell you how I went and figured it out. The other times I would go through the funds and I would try to figure out which ones I should sell, which ones I should keep. A lot of times what I would do is, look at the DPI, especially if I've been holding it for 8, 9, or 10 years versus the TVPI, and look at the fund itself and see, frankly, what I thought was still valuable in it. And if I thought in the market, I might be able to get a better price for it, especially if it was being marked still pretty high, but I had a very low DPI. So it all depends, and it all depends on also what's in your portfolio and how you can package it. You always get a better price if you're able to package, I think, a portfolio of assets, because from a secondary buyer perspective, you're selling them something that has more diversification. And so a lot of times there's a diversification premium that goes along with that. So I'll pause there and see if there's any questions.
And so what do you think the outlook then is for private equity going forward in both of your fields?
Because I'm more middle market, for me, over the last couple of years, I hadn't really seen, as far as private equity making offers on deals or sellers really, coming down on values. I think for private equity, obviously private credit is the name of the game right now. That's not a lie. There's multiple advisors as well, as Maureen said, also coming to service private credit. I just met with Citi's middle market team, and they have 6 individuals that they're building out all of Citi's international brokering services for private credit specifically, and private equity companies. Family offices are included in that, where they can get very high yields on their investments and get to participate in deals that some of these banks cannot facilitate, and banks are not lending money right now, like at all, in any way, shape, form, or fashion. And I know that because I'm raising capital and doing deals all the time. So, and you can just see where their hesitation is at. And that really provides somebody with maybe a private credit fund, or somebody with a lot of money on their balance sheet to lend out as well. So that's one outlook for private equity. Another outlook is that they get to invest in deals such as independent sponsors that are coming up, because they have, I think, I forgot where I was at, but there was a few articles that come up, and also a couple conferences that are gearing more towards independent sponsors and emerging fund managers that are able to tackle down middle market deals, just because it provides, it's much easier to grow a company that is doing 50 million in EBITDA to maybe 35 million in EBITDA than a company that's already at 200 million in EBITDA. So I've seen a lot of people within the private equity market coming down market, has definitely gotten more competitive, I'll tell you that have a strong balance sheets and the funds that are allocated to them to do deals, and maybe either package those deals up with other deals, such as Maureen said, or do smaller roll-ups and then sell them to a larger private equity company, such as like Apollo or BlackRock and things of those nature.
Yeah, just to make a couple comments onto your comments. I've found that sometimes I'll call them management buy-in deals or fund sponsor deals can be actually very attractive, because the individuals that are behind them, provided you have the right alignment, are really hungry and they want to make a success of it. And that's why many times when you look at mid-market or middle market, newer managers, they tend to have outperformance. And it's usually when they get a little bit larger that sometimes the performance drops off. I do think it's also really key when you're looking at the equity check you're writing or the debt check you're writing, is does that manager have the capability to add value to that company at its size or stage? And I think that's a really key thing. I do think that there's probably going to be more activity in the middle market space. It really will kind of depend on what interest rates do, because right now you've seen in the last couple of quarters that M&A activity has popped up because interest rates have come down. And so there's more deal activity going on because nobody really feels like they're being taken advantage of, right? So you're seeing kind of more activity. So that makes me think that there will be more kind of M&A activity. But I do think private credit is really interesting for two reasons. Having gone out to look at financing portfolios, because that's the other thing that many times funds do, is they try to get leverage against their portfolios. And banks will sometimes do it, but they basically off-sell that to insurance companies. And most insurance companies are really picky. They only want to basically buy stuff that's backed by buyout assets. And there's been a lot of venture and growth that's been floating around, and nobody wants to touch that really on the insurance side. I don't work in the sector, but that's been my perspective. So the people who will finance sometimes against broader portfolios of financing are the private lenders, and they're definitely charging 700-800 basis points more than maybe what a bank would lend.
Can we look at things from like a holistic point of view? Like, what are the mega trends? Like, a lot of people are retiring. They want to sell their businesses. Trump's back in office and he wants to reshore. There's a lot of supply chain issues.
Yeah.
What's the right play in private equity to address all that?
Well, excuse me, can I also add to that? When we spoke the other evening, did you not? Sorry. Thank you, Marty. Sorry. I'm so used to talking on the telephone. You mentioned that the current deal you're looking at is private.
Yes. Yeah. I mean, mainly when I'm talking, and it kind of goes to us, yes, the current trends are people are retiring, but an alternative to that is, if you look at Social Security trends as well, people are also staying in their businesses longer. I mean, we've heard so much with people on life sciences on a couple of these panels, people are living longer. So yes, that is true. More people are retiring. More people are looking to exit those businesses. From what I've seen, the question is, because that's what you hear, right? Oh, there's $1 trillion of assets that are going to be transferred, but how many of those assets are good, right? How many of those actually are cash flowing businesses that have built out operations? And just because their kids don't want to take it over, there might be a reason why their kids don't want to take it over.
Well, I mean, the old metric used to be that only 20% of businesses that people try to sell will actually be sold, and only 20% of those will be sold at the price that the person was expecting.
Exactly.
And I think that we had a panel, it must have been 8 years ago, where they said that you had to have at least $1 million of EBITDA to really sell your business successfully.
Yes.
It's probably 2 million now, so I'm not sure how many.
Yes.
companies out there.
That is true. And that's why we're at 2 million. I mean, before I wasn't at that, but there's a level of sophistication within the business at 2 million in EBITDA compared. Now, that being said, there is a lot of individual buyers who maybe, in speaking to you, that are in search funds, or they have their own type of funds that are looking, and there's a lot of people backing those search funds, specifically investors who used to back venture operators who didn't like their returns, or they got burnt a few times, so they want to come to the independent sponsor spot, and they like the fact that a person's going to buy the company and run it themselves, and they're going to build, and he may have a level of sophistication and grit, he or she may have a level of sophistication and grit to build and then eventually exit within that 5 to 7 years. The question is where's that company's at on a sophistication level? I was in a deal recently before I signed this other LOI where the gentleman was only doing like $1.8 million in profit, but he didn't really have a successful team that managed him. There was that key man risk which we've all, I don't know if you've been investing, you probably made a mistake. You buy a company and then the guy leaves and then the whole business goes to shambles. And I could easily tell that wasn't it, but he wanted 4 times his earnings, and at max it was worth 2 times his earnings. And the beautiful part is when you are talking to somebody who may be looking to retire, usually at some point within their career, they started allocating their finances to alternative investments. So they may not be looking for that higher multiple. Whereas somebody, let's say 45 and younger, may be looking for a higher multiple. Maybe he wants that 6, 7X, or maybe he saw that on the New York Post, company A sold for 17X of its earnings, but they're not company A, right? And there is that discussion that you have to have with sellers within the private sector to kind of bring them back to quote unquote reality, because and it is to the intermediary's fault as well, depending on who you're talking to from an investment banker standpoint or a private broker standpoint. How are they managing the expectations of that seller, right? Because you may be coming in as private equity. We look to buy businesses for 3 max 7X of its multiple. I'm not looking to go over that. And I refuse to go over that.
Any special conditions you look for from the sellers? Do you look like self-financing,
There's always
earnouts?
Yeah. So I'll tell you, for an example, we did a deal where we're looking at another deal as well. The seller's going to carry back, he offered, and I think the broker even told him he'll probably carry back $20 million of the deal. When we're looking at the capital stack, we also want that, depending on the debt, I also want that to count as the equity. Sometimes I want them to roll equity there, but there's going to be some portion where we're in it together, because I know when I'm bringing in a private equity fund, or I'm bringing in a family office or a high net worth investor, they're going to want to know who's got skin in the game. I have to have skin in the game. You have to have skin in the game. We're going to uncover everything through due diligence. And it's not just me buying your company. We're going to be marrying each other, right? I'm going to be speaking with you. If something happens, if there's a lawsuit that comes up within that 5 to 7 years, really that 5 years, you're going to be the person I'm calling and yelling at. So I don't want to give you, for an example, $15 million, and then you're in Boca Raton and I can't find you, right? Or you're in Dubai and now we can't extradite you, and you're just not, we're not going to be able to get a hold of you. So there are major special conditions that I have that I know my capital partners want, and Marty's, he hit it right, spot on. There has to be some type of seller finance or rolling equity standpoint. And just as if I can make one comment, if a seller is not rolling their equity, and if they're not putting some type of seller finance in there, there's a big chance, unless, for an example, with a deal, somebody just wants to write a bigger check because they like the deal and they don't want him in there. It's a big red flag for us, because we see that there's something in this business. A business is not a real estate property, and I come from real estate. This is your baby. You built this. You're not a private equity fund. You didn't go and raise a bunch of capital. You built this. This is your baby. And I have a daughter who I love dearly. I'm not just going to sell my daughter off to the next man that comes and tries to marry her. I'm going to figure out who that buyer is, what they want to do. And then I'm going to say, hey, for the first couple years of marriage, hopefully in the future, hopefully she doesn't get married, but hopefully in the future that, you know, I'm going to help you out for the next couple of years. Right. We want them to really be in there, at least at some level of involvement, whether that's from that capital stack or within that 6 months post close.
Thank you. I think we've got the 5-minute warning and
I think
we're
you've got
going
the
over
30-second warning,
yeah,
so
30
maybe
second.
you
Is
guys
there
can
any-
give me
is there-
closing
are there any-
statements and we'll go from there.
Are there any questions from the audience? And if not, are there any
Just closing statements on the outlook for private equity in 2025?
It's going to continue to grow. I think private credit, particularly structured private credit, is an area of interest because there's a lot of pricing gaps right now, and it's a good way to bridge the pricing gap.
I have one comment from Maureen. There is something that's rolled out that's called public-private ETFs. It's it's the next big wave.
Yeah.
private?
I'm
Public-private
sorry,
ETFs.
Closing comments? Dominic, closing comment?
No. If you have any questions, you can get in touch with Marty or just speak with me after. Thanks for having me as well.
Yeah, thank you.
Fantastic.
Thank